once again, everyone, and welcome out to Trading Technicals, the cup and handle pattern. This is a favorite of mine. This was made famous by William O'Neill. He is an author, wrote the book, How to Make Money in Stocks. If you've ever heard of Investors Business Daily, the IBD 50 and 100 and so on, that is him. And so we're going to go through the cup and handle pattern. We'll have a few different takes. We'll talk about kind of historically how you were supposed to trade this strategy, and then some of my own takes and philosophies on it. I've traded it for 20 years or whatnot, and absolutely love the idea of it. We'll go through the psychology, why it works, and how to take advantage. So let's jump into it now. So the cup and handle pattern is basically a pattern through recognition of a key level. And the initial upward phase, if we just do a bullish cup and handle, you don't need to really recognize it early on, because what's happened in the past is that the stock has established a key level and fallen off of there. And everyone can look back at this key level and say, okay, that is significant. That's a big resistance zone. Now, you might argue that there's some resistance in here or in here. You know, this is a head and shoulder top or whatever. But this key level, everyone recognizes it. And so that at that point, it creates that dynamic where there could be, as you start to come back up, a retest of that level. Now, historically speaking, so this creates that cupping type of pattern, right? It's just a rounding out where you basically have established a key level of resistance from the past, and then as you go back up to it, it's kind of a gravitational pull where everyone kind of expects, hey, there's resistance, maybe I'll take profits when we get up to that zone. Historically, in regards to the cup and handle pattern, this pullback here, this cup, should not go more than 50% of the prior advance. So usually you've been in a big uptrend back here, and this isn't really a bottoming out pattern. This is what we would call a continuation pattern. So generally speaking, this would be a stock that's already in a bull market. This could be a stock. This could be Forex, a currency pair. This could be the bond market. This could be an ETF. This could be any asset. But basically, it's been in a bull market, so a strong upward trend. This decline should not go more than 50% of the prior advance. So let's say that we, bottomed out back here somewhere. Well, this didn't give back more than half of it, right? That's about the max. If this were to collapse back down basically to these lows, then it's not really a cup and handle. Even if you started to go back up and created a cup, it wouldn't meet the traditional sense of that. So we've established a resistance. Now here we can see that the pattern is starting to form. We can see the rounding shape to it. Now, I'll give you my own spin on this. The markets have changed a lot over the past years. And it is my belief, I trade a lot of false moves, a lot of little dynamics that maybe I didn't trade as often back when I first started learning about trading a couple of decades ago. When this market, because this is so obvious to everyone, beginner, intermediate, advanced trader alike, the market will typically do one of two things. Either it will stop just shy of this and then start to fall back down, or it will come up and pierce it with kind of a fake false breakout and then come back in. Either way, whether it stops just shy or whether it goes a little above, as long as you're basically in this zone. And so this gets to be a little bit of a big marker. We don't draw this like it's an exact point, like it's a perfect price. We don't say that because the high back here was $73.86 that this stock has to stop at exact. No, it's that zone, anywhere in that kind of 70, 75 zone. If this was 73, right? It's kind of an area. It's a big area that it'll basically stall out at and then start to back up. And if you're trying to be super precise with it, you know, I would say don't try to do that. And I would also say that either watch for it to stall out just shy of that level, or if it goes all the way to the area, then it's probably going to break through. So if you're a really short-term trader and you're just going to be in for a couple of days, you could probably, if it's going all the way to that high, you could probably play it for like a 1 or 2 day break, because it'll have that little false move if it gets all the way to the resistance. I see that often. And it is a fake out. It's a bull trap. Anybody that buys here is just getting sucked into a really bad risk to reward, and we fall back in, and this starts to create the handle effect. Now let's think about the mentality and the psychology. Remember that markets move off of supply, and another word for supply is, you know, shares that are willing to be sold, right? And demand. And demand, another word for that is, well, anyone that's willing to buy. This is the demand. These are people that want to buy or cover their short position. What, for one reason or another, they want to buy, and this group wants to sell. If you think about what's happened and where people are positioned, as this stock recovers, first of all, the reason that it will often react to a prior key level like this is because there's memory here. There's people that bought poorly that want their money back, and they're able to sell. There's natural sellers as you get up to that level, both from people that bought in the past and at poorly timed, right? Really bad prices, but they're being made whole and they want to sell, or people that bought well and timed it well and they want to sell. But naturally, this is an area that brings about supply, that people basically are saying, I want to unload some of these shares at this level. Don't forget, it took a lot just to get back to this. Think about how much demand has been taken out just from the mere fact that all these people that wanted to buy, they bought in, they bought in, they bought in, they bought in. So a lot of the buyers are not going to see this as a very attractive level. They're like, well, I'd rather take profits here than buy more, right? There's a natural kind of shift where this becomes a more attractive place to supply the market or sell shares, and it's a less attractive place to buy. Sure, you might suck in some people on this little false move or something, but those are short-term traders trying to catch a little breakout or whatnot. It's probably not real aggressive, sustainable demand. And so we need this next decline to kind of create this effect where, okay, it calms. It's called a correction because it not only corrects back the price, it corrects over time, and it kind of allows, it's a resting period, right? And as this correction starts to occur, this handle here, a lot of people will start to clamor and say, oh, this might be a double top, right? And it could be. This could be a peak, and that could be the second peak, and away we go to the downside. That's possible, but I just don't try to predict double tops and double bottoms. They will happen on occasion, but they're not the most likely outcome. What's much more likely is that this stock is going to go up, up, and away. That is going to be a greater frequency of occurrence than that this double top occurs and away we go to the downside. And frankly, the way to know this is a double top is once it starts to break beyond where this handle should be formed. This handle is normally 30%, roughly, I should say, in the area of about 30% of the size of the cup. So remember, this is your cup in here. As we start to form the handle right here, the handle is usually about 30% of the size of the cup. So the handle's always different for each stock based on how big the cup was. Well, let's throw some numbers out here. Let's say that we called this resistance, I think we said 73 or something. And let's say that the bottom of this cup was down here at like 58. or something like that, dollars per share. And again, I'm not going to exact numbers. Notice I didn't put 73.24 or something and 58.11. I just said 73-ish and 58-ish. That's the size of your cup. So hypothetically, if we hit our resistance at 73 here and we came back and kind of retested it in the 73 zone here, but this low area was 58, what's the size of the cup? Well, in this case, that's 15 points. $15 per share if this is a stock. So 15 points. Well, the handle will usually be 30% of the size of the cup. So one thing that we can do is actually pull up a calculator and calculate that. Let me pull one up with you. If we say, okay, $15 is the size of the cup times 0.3, the handle in this case should be about $4.50. That's 30% of that, right? We just do a calculation. Whatever the size of the cup is times 0.3 will give you the size of the handle. So what does that mean to us? Well, if the resistance is 73 and the handle should be about $4.50, 73 minus 450 tells us that the handle should bottom around the general area of about 68.50. 68.50 is around where that handle should bottom out down here and start to work its way back up, okay? And start to come back up towards that resistance zone. Now, you'll notice that the handle usually has kind of a curvature similar to the cup. There's usually a rounded type of aspect to it. This could be, hypothetically, this could be really long-term chart. This could be a really short-term chart. We could be looking at a chart here that is multiple years, like maybe this resistance was in 2020, and then we retested it in 2022, and now we're creating the handle through early 2023. I mean, something like that could be in place. It could be a situation where this is, a couple of weeks worth. We hit this resistance 3 weeks ago. We retested it now, a couple of days ago, and now we're kind of pulling back and creating a little handle. This could be on any time frame. Of course, we want to see this type of characteristics that aid and assist us in being able to identify what should happen. And it's really, really bullish. I mean, it's just, if you think about the psychological aspects of it, we stalled out here some time ago. We fell off. That's the big correction. That's, kind of the little bear market type of pattern. We were strong enough to recover, but of course we need a breather, and now we've got that. Now it could really be fun to the upside. Other traders may even call this an ascending triangle because it really has that same type of look to it. See how you could draw a trend line under these lows and you've got the flat top resistance. So whether you see it as a cup and handle or kind of an ascending triangle, any way you slice it, that's pretty darn good and pretty darn bullish. Now for me, I like to buy here at the expected handle bottom. This is one of my favorite spots. Now that's not how it's traditionally taught. You'd kind of wait and make sure that it's breaking out and then buy on the breakout and try to target this big upside move. But because I know that most of the time this isn't a double top, that in fact it's more of a cup and handle / ascending triangle, buying down here at the trend line, buying down here at that 30% where the handle is about 30% of the size of the cup, the risk to reward and probability mix on that is fantastic. When I get that criteria coming together, I really like that setup. So if I can buy in here somewhere, I'm a happy camper. Now, will I get stopped out sometimes and hit a stop out point or losing trade? Of course, nothing works 100% of the time, but that's actually my favorite entry zone, is somewhere in there. Now, also, you could buy on this break as it breaks out of the cup and handle. There's a couple of upside targets. First target would be a quicker target. First target would be to take the size of the handle and flip it upside down, over the top to say, well, here's how far we should break out. So if the handle is about $4.50, then how far should we break out initially? About $4.50 higher. So if resistance is at 73, $4.50 higher is a target of 77.50. The size of the handle flipped this way is your first shorter term target. Okay, that's a short term target. Take the size of the handle and stack it on top of the breakout zone, and that gives you your shorter term idea. Well, what about a longer term target up here? What if we really wanted to be in for an extended period of time? Well, then you'd measure the entire size of the cup. And you'd say, well, it was 15 points and resistance is at 73. Stack that 15 on top of 73, and now you've got an $88 target, right? 73 plus 15 is $88 per share. Now, that would take quite some time to get there. Months, potentially weeks if it was a really high volatility stock. If it was a really slow mover, it might take a year. I don't know, but that would be a longer term target or a much more optimistic, stick with it, big picture for an extended period of time target. So you have a couple of natural measured moves targets where you measure the handle. That's a shorter term. You measure the size of the cup and flip it upside down. That's your longer term target. Okay. Now, the cup and handle is not always bullish. Sometimes you get an inverse cup and handle. So what is an inverse cup and handle? Well, no shock and surprise. You find something that's been in a downtrend. It establishes a key level. You start to rally up, right? You stall out. You come back down. And I'm not, trying to draw this perfectly by any means, but you can see, again, you don't have to predict anything. You don't have to kind of guess at it or whatnot. It's clear to see. Everyone, whether they're new to trading, intermediate, or advanced, can see this major level of support. They can see that the stock rallied off of that and then started to go back towards it. Again, it won't normally be this clean. You'll oftentimes kind of pierce through and then come and so forth. But let's say that this low was at $52 per share or something like that, hypothetically. That's the support zone. It's a whole area in the 52-ish range. Well, we can see that we rallied up off of it. Now we're coming back to that zone. Again, here, it's probably a fake out if it tries to break through initially because you've already expended so much energy, so much supply and selling pressure just to get back to this zone that any breakout is unlikely to just keep running and running and running. It's probably a fake out. It's probably a bearish trap, and it's probably going to have a corrective phase. Well, as it starts to correct, now we've got the cup and handle. Here's your cup turned upside down, inverse cup and handle, right? And let's say that the high up here was 71 per share or something like that. So now we know the size of the cup. We say, okay, big rally off of those lows, 52 to 71. We could have made it a little easier on ourselves and called it 72, but that's fine. 19 points. $19 per share is the size of the cup. So where should this handle stall out? Where should the top of the handle be located? Well, once again, we can calculate. We can say, okay, well, if the cup is 19, then multiply that by 0.3, and the handle should be about $5.70. So 570 above that gives us 57.70. That's the general area, is about $58 per share, somewhere right around there. And again, it's not going to hit 57.70 and just stop right at that exact number. It might be at 57.20 or 58.10 or whatever. It's in that zone, but that's where it should stall out and fail. You know this isn't an inverse cup and handle if this thing blows through there. If this stock gaps up to 61, well, you're advancing too much. That's not a cup and handle here. It might be a double bottom. It might be a lot of different things. It could fail still, but it's not this price pattern. Remember, if it goes too high, it's not an inverse cup and handle. It's not a descending triangle, which often look the same, right? So have similar characteristics. It's just not that. This is one of my favorite entry zones, is right around where the handle should be located at 57.70. I'm going to be watching right there to see if it gives me a bearish setup. Form a bearish candlestick pattern. Kind of show me that you're stalling out there and pivoting over. And this is a bearish entry zone. We are betting that the stock is going to trade lower. And we're getting in before the cup and handle is fully formed, but as it's starting to turn over, right? As the handle is starting to turn back down. Now, what would be your price targets? Well, if I entered here, frankly, I could target a move back to support at 52. I'd already be up 570 in the trade, right? Or a shorter term target would be a measured move, would be to take the size of the handle and say, okay, that's $5.70, 570 below 52 gives us an initial target of 46.30. Somewhere down around 46.30, I could take my profits off. If I want a big target and to really stick with this longer term, and I think disaster is coming to this stock for a while, then I'd take the size of the cup measured from the support. So I'd go, well, 52 is support minus the 19 for the cup size. That gives us a big long-term target down here of $33 per share that you'd be targeting. So 19 is the size of the cup, flip that upside down, and that gives you your long-term target. 570 was the size of the handle, flip that upside down, and that gives you your short-term target. So those are a couple of natural profit-taking type of areas that you could be looking at in this chart. So now let's go live and look at a few charts of just examples of how this might look in everyday trading. And I find that I trade these quite often. I just look for this type of criteria, look for this type of dynamic, and I'm looking for these types of price patterns. So here being an example, if we pull up Square, or I guess this is now called Blockchain, this company Block, if you look at the price pattern, first of all, we can see that this was a big developed downward trend. So it's clearly in a bear market. So we're focused and looking for inverse cup and handle patterns, right? Bearish dynamics. And I love something that kind of consolidates at the prior lows. And that's what this pattern's looking for, is something that hit a key low that everyone, beginner, intermediate, advanced, we can all see that we came off of that low significantly, that was a key level of support, yada, yada, yada. Now you can see the rounded nature of this, right? We can see that in place. We can see that we came back to test this and see what I talked about, how the markets now, they just have a tendency to kind of do this little false type of move. You could already be in block as a bearish setup, essentially from that handle on down. Or a lot of times it'll have a little bit more rounded nature to it, which is kind of what I think this one did. It's just consolidated here for a couple of weeks. And now we're in the process of starting to break lower and break down. A couple of different ways you could play it You could have gotten short there or really in there. Either way, you're kind of creating this handle effect. Notice that the handle, if we were to put some numbers around this, might be kind of interesting. So let me put some price labels on it. And if we look at the price labels, and then again, let's annotate it back up a little bit. So if we call the support around 56, and we call the resistance up here about 92, I think you can see that's definitely the cup, 56 to 92. Let's pull out our calculator and let's see what that is. Well, 92 minus 56, that's a big cup. That's a 36-point range. It speaks to the volatility. And so the size of the cup is 36 points. Okay, that's big. Now, what is 30% of 36? Well, it's about 1080. So from about 56, and you could even call it 54, but basically going up about 10 points. The handle should get no higher, essentially, than about 66 is kind of where the handle should be in terms of its size. And we got up to 63.44, not quite up to there. If you had used this next retest, it was basically that 30%. But either way, it's kind of stalling out in the area that it should. Now, it should not surge up here into the 70 range. That would be too much. Clearly, it's not an inverse cup and handle pattern and such. But this rounding, and clearly you've made some, if you're shorting anywhere in here in the low to mid 60s and it dropped 10 points quickly, came back up, it's dropped another 10 points quite quickly, but it's the criteria, it's the characteristics. Now, it'd be a very, very long-term and aggressive target to expect a 36-point drop from 56, right? I mean, that would be targeting this stock essentially to go to $20 per share. But if we take the handle of about 10 points and say, okay, 56, 10 points down, 46, that might be your shorter term target and would probably be more realistic of what we would be looking for as a trader. If you're going long-term targets, those are more, I'm going to stick with it through thick and thin, through good times and bad times and so on, and be in this for multiple months, because this stock's probably not going to 20 for many months. It could go there. It absolutely can go there, but it's probably going to take some time. Let's think about some others. NUE, kind of an interesting chart pattern. Here's a case where I think we're kind of creating a few different patterns within patterns, which is interesting. So first, the obvious resistance up here. I mean, everyone can see that peak. And I think that this is all part of that rounding out effect of that cup. So I kind of think we're still in the big cup pattern. But if you broke it down even a little bit further, within this bottoming out process, we've kind of created this little mini cup and handle pattern. If you see it, this cup and handle. Now, this peak did not quite get there. Remember how we talked about it'll often just either stop just shy or pierce just a little above and do a little fake out move. This one stopped a little shy, but I think that's okay. Still a nice little corrective pattern here. Whether you call this, remember, they often look the same. That you can call this an ascending triangle, which is exactly what it is, or you can call this a little mini cup and handle. Any way you slice it, today looks like an interesting day to buy, because if we do some back of the envelope math and we say, okay, let's measure this thing out. If we take from about peak to trough, there's your cup. I get that we didn't fully perfectly retest. We stopped at 140 and the highs here were at 145. That will often happen in today's markets, okay? We either stop shy or we just pierce through. That's very common. It's less common to see something that's perfectly clean. You sort of have to almost kind of expect the market to do the things that frustrate the most amount of people, right? If in fact, if I were to look back here, I would say this is a cup and handle. Now, someone might say, well, but it didn't touch. That was a peak of 125, and this one only went to 121. It's it's the same thing. I mean, it's the same general area, right? You recovered after a huge decline. See that big decline? You recovered back to the same general area. Do I care that this one wicked up a couple points more? No, we recovered back, and then notice we fell off of there and had this little correction, okay? And so let's look at that one. Look at the math on it. I didn't plan to use that pattern. I just spotted it here for a second. So I'm going to call the top, I'm going to call the resistance about 122. Forget about the fact that that wicked up to 125. I'm going to say 122 area to the 80, 87, 88. It doesn't really matter. It's not an exact science, but let's call it 34 points. That's the size of the cup. So the handle should be about 30% of that. So about 1020. From 122, if you backed up 1020, you should have backed up to about 111.80-ish. And 110.80 is close enough. That's right in that 30% size of the cup. That's perfect. I mean, that's clean. That's fantastic. Do I care that it wasn't exactly 30% decline? No, I don't expect it to be. And from there, well, what would be our target? So probably about 1020 above 122 would be the first target, right? Somewhere in the 132-ish range. So if you were playing it short term, 132, it peaked at 138, but you'd have taken your profits somewhere around 132 potentially, maybe the day before. And then you can see it proceeded to go up, 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 up. If you had played it long term, you probably got there. What was the long term target? 122 minus 88 was 34. 34 plus 122 is 156. That would have been your long-term target up in here, and it went all the way to 186. So I think you'd have taken your profits actually right back here before this decline. The fact, I mean, that's close enough to 156, right? You'd have been taking your profits on the longer term because that's as big a move as that. It doesn't look like it may be because I have this on log scale. If you go to linear, you'll see that it is the same. That size of this cup is the same as that move. That is the same as that. See it? Okay, that and that. There you go. And this handle is the same size as that initial move. So short term, whether you bought in the handle or on the breakout, short term, you'd have been taking your profit up there. Long term, you'd have been taking your profit up there. And you're not catching, it's not designed. I mean, nobody can buy here and sell here, right? We're looking for patterns that give us a higher probability of success. Even if you don't see this like I do as a cup and handle, well, you still see it as a bullish price pattern. You still see that the 20 is crossed up above the 50, that this is an uptrend line, that we're on the uptrend line. So there could be, you know, like we say, patterns within a pattern. Plus, you can still see that this has bottomed out and is in a rounding situation, that this bottom is higher or equal to that one, and that we're proceeding to advance. And frankly, I think the next phase is a push up there towards 145. So we highlighted a couple of these charts. I do the market roundup. I highlighted a couple of these stocks this week. and saying, hey, these are on my list and these are patterns that I'm watching for development. I actually already took a short in Square, which reports earnings later today, and it's already hit my price target today. So, I can take profits or I can risk it through earnings. I've got a decision to make because I've got a nice trade there. In UE, I don't have a position. By the time I'm done with this class, I may have a bullish position in UE targeting. I could target as much of a move up to 145. I could target short term a move the size of the handle up above there. So I've got a couple of potential targets. I probably will not take the long-term target. But if I thought this could go all the way back up to that peak, frankly, that's exactly what this long-term target would be a move back up towards 185. You see that? Because the long-term target would be the distance of the cup, which on a breakout would be about equal to that. The short-term target is the distance of the handle, which would put us up closer towards, the high 150s would probably be my target there. So those are the price patterns in action in the cup and handle. So we'll leave it there, but I hope you enjoyed this class on the cup and handle. I hope it gives you some ideas of both the bullish cup and handle, the bearish inverse cup and handle, how to measure them, how to target out of that trade, how to identify good risk reward probability mix. And then of course here at Maverick, we'll teach you option strategies to overlay on top of those, how you can do targeted butterflies and different things. If you had a shorter term or longer term target that can also give you a fantastic risk to reward. Sometimes I'm risking 1 to make 6 or 7 times that amount of money with a targeted butterfly. So hope you enjoyed it. Have a great rest of your day. On behalf of Maverick Trading, I'm Corey Halliday, and we will see you next time. Goodbye, everyone.